The third financial statement that we prepare is our balance sheet. Sometimes it's also called a statement of financial position. This is the one that has your accounting equation. The balance sheet reports assets, liabilities, and stockholders' equity. The balance sheet also classifies this information into more detail. Assets are split into current assets and long-term assets. Current assets are assets that we expect to use up within a year or less, and long-term assets are assets that we expect to hold longer than a year. Current assets and long-term assets are listed according to their liquidity in the balance sheet. Liquidity means how easily it can be converted to cash. These are typically the type of items you will find under current assets. Let's go through each of these items. Cash is generally how much cash you would find at a particular point in time. Short-term investments are investments that the company has made. Typically, these are investments in other companies. Accounts receivable and notes receivable are current assets as well. Accounts receivable is a term that companies use when they sell on credit and they have not received the money yet. For example, if you go to the dentist office after the services are provided, when you're leaving, if they say we'll bill you later, they have already provided their service to you. So they've already sold their goods and services. They are a service provider, so they've already provided you a service. But you have not paid them. So they are waiting to receive cash from you. Let's say that the services amounted to $150. That $150 will be shown in the dentist's books of accounts as an accounts receivable from you. Notes receivable is just like accounts receivable, but it's a little bit more formalized. There is a written agreement. The easiest example is a bank. If you go to a bank and you decided to borrow $10,000, the bank will make you sign a note, and the bank will say you will have to pay back the $10,000 plus interest on whatever you borrowed. For the bank, the $10,000 would be a notes receivable. It's an accounts receivable, but it's a little bit more formal, and typically interest is payable on a notes receivable. We talked about inventory before. Inventory is a current asset. Inventory represents the amount of inventory being held by a company. So JCPenney, Walmart, all those companies will have inventory. Prepaid expenses. Prepaid expenses is a current asset. I'm going to give you a personal example of what a prepaid expense is, and companies have very similar expenses. Let's say that you wanted to rent an apartment, and the apartment was going to cost you $500 a month. You are a college student with not much credit history, so the apartment owner said that you would have to prepay your rent. You would have to pay up 6 months of rent in advance for you to rent that apartment. So in order for you to get the apartment, you had to pay $3,000 up front. Let's say you did that on the 1st of January. Now you have prepaid 6 months of your rent. Companies do the same thing. If a company pays in advance for rent, advertising, or insurance, that would be shown as a current asset as prepaid expenses. Now let's take a look at long-term assets. These are items that will be held longer than 1 year. Typically, you're looking at things like land, buildings, computers, equipment, furniture, or sometimes long-term investments. All those items that will be held longer than a year will be classified in a company's balance sheet as long-term assets. The second type of items we have in our balance sheet is liabilities. Liabilities also are split into current liabilities and long-term liabilities. Remember, liabilities are what we owe to outsiders of the company. Current liabilities represent debts that are payable in the next year, so in a year or less, and long-term liabilities are debts that are payable that are due after 1 year. The typical items that you will see under current liabilities are things like accounts payable, income taxes payable, and what we call accrued expenses. Accounts payable and accrued expenses are very similar. we use the term accounts payable to reflect whenever companies buy inventory on credit, and accrued expenses is the term we use whenever companies use up things like electricity and they have not paid it yet. So electricity salaries, if we use it up but it has not been paid yet, it's shown under accrued expenses as a debt. Let me give you an example. Let's say that we are looking at our balance sheet as of December 31st. So if we look at utilities expenses, the December's utility bill, we would have used up electricity and water for the month of December, but the utility bill would not come until middle of January. We used up our electricity, but we have not paid for it yet. In accounting, if we use it up, we have to recognize that we used it up. It is an expense, so we would show that as an expense in our income statement, but it would be also a debt in our balance sheet. You don't need to worry too much about that. We're going to cover that in chapter 2, but just know that accrued expenses relate to debt that we have not paid for expenses, and it's a current liability. The two things that you will see under long-term liabilities are long-term notes and bonds payable. Long-term notes relate to mortgages or long-term borrowing from banks. Bonds payable are when companies issue bonds. You don't have to worry about that too much. We're going to cover that somewhere around chapter 10. But just know that when you see those two, those belong in the long-term liabilities section of your balance sheet. The last category of your balance sheet is your stockholders' equity. And as you remember, this represents the stockholders' ownership portion of the assets. The three things that you will probably see around this part of the semester is just common stock, additional paid-in capital, and retained earnings. We will expand on the stockholders' equity section later. For now, just know that these three items will appear in this order on the stockholders' equity section. Common stock relates to amounts stockholders have contributed, amount investors have contributed. Retained earnings relates to the amounts earned and retained by the company. This is what your typical balance sheet looks like. On the left-hand side, you will see the assets broken down into current and long-term assets, and on the right-hand side, you will see liabilities and stockholders' equity. Remember, your accounting equation is found on your balance sheet, so assets will equal liabilities and stockholders' equity. Sometimes you will see it in this format, sometimes you will see it in tandem. So you'll have assets on top, and then right below that, they'll list liabilities and stockholders' equity. If you want to review all the terms and have a record of what each term means, there's a glossary at the end of your chapter. It covers all the accounting vocabulary. Also, in your My Accounting Lab, you can go and there's a set of index cards that you can look at under the multimedia library section, and that will have those definitions as well. Now let's take a look at how we prepare the balance sheet. Again, the first thing always is your header information. So you got ABC Corporation, which is a name, balance sheet, which is the name of the financial statement. Now here you've only got a date. Remember, this is the one that we prepare as a snapshot. It is not a period statement, so it's not for the year ended or for the month ended or for the quarter ended. It is a point in time. This point in time is December 31st, 2012. Now let's look at the assets. We're going to start off with the current assets, and all you do is add up the three current assets to get you your total current assets. So you will add your cash, inventory, prepaid expenses, and that will give you the total for your total current assets. Next, we move on to the long-term assets, and we will take your property and equipment. Whenever you see accumulated depreciation, that is a balance sheet item. We're not going to explain it. I'm not going to explain it at this point because we're going to cover that in detail later down the road. But if you see the term accumulated depreciation, that needs to go along with your property and equipment and it needs to be subtracted. So property and equipment less accumulated depreciation will give you net property and equipment. The next is other assets. Basically, those would be the long-term investments or anything that doesn't fit into the current assets category. Finally, to get total assets, you are going to add up your total current assets, your property and equipment, and other assets, and that will give you your total assets. Next, we move on to the liabilities and stockholders' equity section. Accounts payable, taxes payable will give you your total current liabilities. If there's another short-term liability, you would put that there as well and add that. Next, we have our long-term liabilities. You would add your long-term liabilities, and that will give you your total liabilities. So total liabilities is total current liabilities, which is number 4, plus long-term liabilities, which is number 5. Next, we have our stockholders' equity section. We've got 3 items: common stock, additional paid-in capital, and retained earnings. And you would just add those 3 items up to get your total stockholders' equity. Once you have your total stockholders' equity, now you can complete the last line, which is total liabilities and stockholders' equity. That would be the total liabilities here plus your total stockholders' equity here. You would add those 2 up. Remember, this is a financial statement that has your accounting equation, which says assets equals liabilities plus stockholders' equity. We have your total assets here, total liabilities and stockholders' equity here. So if you prepared your balance sheet correctly, these 2 items would be in balance. Some of your homework questions and your quiz questions will give you certain numbers in your balance sheet, but they will not give all the numbers. So you may have to use your knowledge of how everything fits in to fill in the blanks.